let's jump right into this rigorous fundamental valuation of Texas Pacific Land. We're putting on our sell-side analyst hats today to uncover TPL's true intrinsic value, looking strictly at its latest metrics. In this explainer, we're going to treat the raw financial data of this multi-billion-dollar entity like a giant puzzle. We'll run absolute and relative valuation models to see if the underlying math actually justifies the current market price, working strictly with the numbers right in front of us. To do that, here's our game plan. We'll start with TPL's core fundamentals, then dive into absolute valuation using DCF and dividend models. After that, we'll check out residual income and APV. Then we shift to relative valuation, the market lens, before tackling the missing pieces and finally delivering our final verdict. All right, Section 1, the target, TPL's unique financial profile. Let's look at the suspect here, a $27.4 billion company with a number that literally jumps off the page, 0. TPL operates with a mathematically perfect zero debt-to-equity ratio. In the mega-cap world, finding a fortress balance sheet with absolutely no leverage, it's incredibly rare. It basically means they are totally immune to the immediate squeeze of rising interest rates. And that lack of debt brilliantly highlights their massive profitability. We're talking a net profit margin of 62.34% and gross margins nearing 94%. Let that sink in for a second. For every single dollar of revenue that comes through the door, over 62 cents drops straight to the bottom line as pure net income. It speaks to a wildly asset-light business model where costs are honestly just a rounding error compared to the top line. Now, check this out. An astronomical return on invested capital of 32.84%. That is extreme capital efficiency. What's kind of fascinating, though, is that the source data shows this is actually down from a 3-year average of over 82%. But look, regardless of that drop, TPL is still generating absolutely massive returns on the cash it actually deploys into the business. But here's the friction. Here's the plot twist of our explainer. How does a debt-free company with these massive margins currently have a negative trailing free cash flow? On paper, a 33% return on equity should be throwing off serious cash, yet the data shows a trailing 12-month free cash flow of negative $3.8 million. This anomaly right here, this is the central mystery we've got to solve as we try to value the company. Moving on to Section 2, absolute valuation, discounted cash flows and dividends. To crack this mystery, let's start with intrinsic math. Now, the discounted cash flow or DCF model is the gold standard for intrinsic value. But, it struggles heavily when your current free cash flows are negative. If you're basing your entire valuation on cash flows, starting from a negative number means you have to assume some massive future turnaround growth just to hit a positive baseline. To run the DCF, we follow the standard logical steps, but we have to apply what I like to call our assumption asterisk for the discount rate and terminal growth, simply because the source documents don't give us those specific forward-looking inputs. Since TPL has zero debt, the weighted average cost of capital is literally just the cost of equity. But without a stated equity risk premium in our source, our fair value result relies heavily on external assumptions about TPL's future growth curve. So what's the result? Well, based on the calculated free cash flow fair value of just $79.56 against a $394 price tag, the DCF is screaming a massive negative margin of safety. The disconnect is honestly jarring. The intrinsic math derived purely from free cash flows suggests the stock is worth roughly $80, but the market is happily paying nearly $400. The intrinsic model just cannot reconcile with the market price, giving us a negative 395% margin of safety. Okay, since the DCF is giving us a lot of noise here, let's pivot to the dividend discount model. This actually shines for TPL because of their incredibly consistent payout history. When cash flows look temporarily distorted, analyzing the actual cash return to shareholders via dividends can give us a much steadier valuation baseline. With 19 consecutive years of increases and an 18.52% 3-year growth rate on a super safe 31.52% payout ratio, a multi-stage DDM provides a really robust foundation. Yes, the yield is tiny at 0.61%, but that growth rate is aggressive. Forecasting 18% dividend growth over the next 5 to 10 years before eventually tapering to a perpetual growth rate gives us a highly reliable, if conservative, estimate based completely on management's consistent capital return behavior. Let's move to Section 3, absolute valuation, residual income and adjusted present value. Let's see how our case builds using residual income, which leans on earnings and book value equity charges instead of just cash. The source data reveals a fair value based on EPS of $184.73. And honestly, this makes perfect sense. Because TPL has that staggering 62% net margin and robust EPS growth, valuing the company on its earnings power yields a much higher result than its negative cash flow. But wait, at $184, we are still way below the current market price. Next up is the Adjusted Present Value, or APV model. This isolates the value of operations from the financing benefits of debt. Normally, you'd calculate the firm's base value and then meticulously add back the tax savings the company gets for paying interest on its debt. But for TPL, the APV is incredibly straightforward. With a debt-to-equity ratio of exactly 0, there are 0 tax shields to calculate. So firm value equals unlevered equity. Simple as that. There's no hidden value locked away in clever debt financing. What you see in the unlevered operations is exactly what you get. All right, Section 4, Relative Valuation, the Market Lens. Now that we've got our intrinsic baselines, we really need to see how the market is actually pricing these unique fundamentals today. Since our source didn't provide external peers, we're comparing TPL against its own historical averages. And wow, it's trading at a premium 56 times earnings compared to its 3-year average of 48. And EV to EBITDA of nearly 42 is exceptionally high, which tells us investors are expecting massive future earnings expansion. Interestingly, the forward PE drops down to 37.74. This means analysts do expect near-term earnings growth to accelerate, bringing the valuations slightly back down to earth. Though, let's be real, it remains quite expensive by any traditional value metric. On to Section 5. Missing pieces, data limits, and untested models. Look, a rigorous analyst has to admit where the trail goes cold. We are deliberately skipping some of the parts and detailed net asset value models here. Why? Because the source documents simply do not provide the distinct segment reporting or line item balance sheets we'd need. Without knowing exactly what distinct assets TPL holds or how they generate different streams of risk-adjusted revenue, carving this company up into parts would just be pure speculation, and we don't do that here. We stick strictly to the consolidated data provided. Finally, Section 6, Synthesis, the Final Verdict. Let's pull all these threads together, shall we? Our step-by-step models reveal a massive disconnect. Intrinsic models peg the value somewhere between $79 and $184. Yet, the market is eagerly shelling out $394 a share. The cash flow models absolutely hate the current trailing cash burn. The earnings models love the margins, but just can't stretch to hit that current price. And the relative multiples, they show the market is basically ignoring the intrinsic models entirely and pricing in massive future optimism. To sum it up, the forensic evidence reveals a financial anomaly. A debt-free fortress generating 62% net margins, yet priced so optimistically that its intrinsic models struggle to justify the current market cap. That perfectly captures the tension here. The operational metrics are flawless, but the math says the stock is priced far beyond its foundation. It's a classic showdown between deep value intrinsic math and pure, unadulterated market sentiment. So, I'll leave you with this final thought. With 0 debt and massive margins, but trading at 56 times earnings and negative free cash flow, is TPL priced for perfection or poised for a correction? Think about that as you review these valuation models. When pristine operational fundamentals vastly outpace the math used to value them, something eventually has to give. Does the math catch up to the market, or does the market fall back to the math? Thanks for joining me on this forensic dive, and keep questioning the numbers.